Hey guys, Stockaholics, thanks for being here today. In my last video, I talked about why I think that the US housing market is currently signaling a recession for the United States. However, I also hinted at that I think that there is some things that are developing that look really interesting to me in real estate, specifically in some real estate businesses that are out there right now. Over the last couple of years, there's been a weird dichotomy that's happened in real estate where some parts of real estate have done extraordinarily well, and other businesses involved in real estate have done extraordinarily poorly. And as a cyclical investor, when I see these kind of cyclical businesses doing extremely poorly, I start to get some gears turning in my head. I ask questions why, and then I think about it in terms of investment, and if I think that those conditions are likely to change. And I do, and I think that there are some parts of real estate that look very exciting. And I wanted to explain kind of what's going on and what the parts of real estate that look really interesting to me right now. All right, we're going to start with a chart of existing home sales in the United States. If you don't know, I guess there's two main kinds of houses out there. You got brand new houses when they're built by a home builder. And if you buy that, that would be called a new home sale. And any other time a house is sold after that, we would call that an existing home sale. So we're measuring this going back 20 or so years, right? In this chart, there's been some wild fluctuations that have taken place recently, but I drew this line in the middle at about 5.3 million sales, and that is probably about the average amount of home sales that we've seen over the last 20 or so years, right? Now, in 2020, 2021, we had that pandemic, lockdowns, and as a result of that, the powers that be decided to lower interest rates to extremely low levels. And as a result of that, you saw a surge in existing home sales. Right after that, because of the inflation that ensued from all of the shenanigans happening at that time, the Federal Reserve spiked interest rates to a record high, at least in terms of change. So they raised the rates at an extremely rapid rate. And as a result of that, right after that, the market changed overnight in existing home sales, and it went from a relative high to an extreme low. To kind of put some context to where we are in terms of existing home sales today, when you adjust this for population, we are at all-time lows. So over here was the global financial crisis in about 2009 or so. You started to see US existing home sales bottom 2010. And today we're at about the same levels, right? But we have 50 million more people, right? Now, there are a lot of businesses involved in existing home sales, right? I think a lot of people out there, when they think about homes, they think about investing and things like that. They think about all the things that go into a new home, right? But there are tons of businesses that are involved in this part of the market that is in the absolute gutter. Now, when we're talking about cyclical investments, these types of businesses get really interesting when you're in terrible conditions because the market generally underappreciates those conditions. I know there's a mantra out there in the stock market that says, oh, you know, the market is forward looking. Well, at least when it comes to cyclicals, it never is. I'm gonna let you know that right now. They project current conditions out into infinity, right? So a lot of these stocks that are involved in existing home sales transactions in 2020, 21, and the beginning of 2022, they did extraordinarily well. And subsequently, they tanked tremendously. And I think that there is a lot of opportunity involved in these businesses right now, specifically because I think that they're underappreciated and unloved because of where they are and their current markets. To add a little more color to what I was just talking about, this is the HOAM index from the Federal Reserve Bank of Atlanta, and it's basically measuring how affordable houses are for the average person, right? And it's going back to about 2006. Where we are right now, we're in extremely unaffordable conditions. Now, there's a bunch of reasons for this we can talk about. I think one that gets underappreciated is actually the inflation that we saw. The way inflation tends to work usually over, if you measure it through history, at least in the United States, is that and it's always a monetary phenomenon, but when new money is created, it doesn't tend to go through the economy evenly, right? One of the last people that are able to receive any benefit, if you can call it that, of inflation are, the working person. So if you have a wage, you are much less likely to receive an initiative bump in your pay as inflation strikes. What happens is that over a few years, your pay tends to catch up with inflation as the conditions worsen in that inflationary environment, right? You can look at this at any historical part in history, and wages always lag inflation. They always lag over a couple of years. Pay raises, they lag the money creation, right? And we saw a tremendous amount of money creation in 2020, 2021, 2022, and wages have been stagnant. They haven't fully caught up to that inflation wave yet. Now, I do expect that they will, but that's one thing, I think that is weighing down on this market. Another thing is there's been increasing insurance premiums in different places. I know in Florida, like there's a big issue going on down there with insurance rates, and that's making it unaffordable. But obviously, I think the 800-pound gorilla in the room for affordability is interest rates, right? And that huge spike that we saw in interest rates is, if not, it's definitely the biggest contributor to that affordability, right? Now, again, like I said in my last video, I think that there is a high probability of recession, and because of that, because where we are, I think in the cycle, I think that it's also very likely that we start to see interest rates drop over the next couple years. And because of that, I expect this home affordability to increase. And I think that the amount of existing home sales out there, I think it's also likely to mean revert. One more thing that I don't see get a lot of attention on why housing has gotten so unaffordable, and we're talking about these interest rates, is spreads. And if you don't know, this is a chart of the 30-year mortgage rate compared to the 10-year treasury. So typically, when a bank is thinking about offering an interest rate on giving someone a mortgage, a loan for their house, they compare it to what yield they can get on a 10-year treasury bond. And so if you were to measure like the 10-year against the 30-year mortgage rate, they tend to balance. They go up and down with each other, right? Now, over the last couple of years, just like we've seen awesome, crazy stuff happen in different parts, we've also seen these spreads between these blow out even to extreme levels, right? Now, there could be a bunch of reasons for this. I don't know exactly why this is, but if you look at the history of these big spreads, and again, normally we fall somewhere between a 1.5 to 2% range of a spread. Over the last couple of years, we've ranged high 2s to 3. So an additional 1.5 interest rate being charged on a mortgage than you would see normally because of these spreads, right? So it's not only that the Fed raised interest rates real high, but there's some kind of stress taking place in the banking system or in housing in some way where the banks see increased risk in giving people mortgages. And so they're charging bigger spreads on that, right? And so this is probably also related to the tightening cycle that we saw. And I think that it's also probable that these spreads start to compress, making mortgages even more affordable in the future when the Fed decides to lower interest rates. Okay, we're looking at a chart of US household inventory. These are homes available for sale at different times. And you can see it just like in some of those other charts, 2020, 2021, 2022, the available inventory tanked. And so because of that, it became a seller's market. There was a tremendous amount of buyers relative to sellers, so housing prices appreciated rapidly. I think this is in conjunction with obviously all the monetary nonsense that we saw over the last couple of years too, right? But the good news is that with these higher interest rates, we're starting to see this inventory build, right? So it's starting to shift from more of a seller's market to more of a buyer's market. And when we're thinking about affordability and we're thinking about transactions, we really want to see this start to build, because if and when interest rates do start to come down, that's going to push more demand out there for buyers. And again, in terms of sales and transactions volume, we want to have some available inventory to sell so we don't see that same kind of home price appreciation spiraled out of control, just like before, right? So I guess if there's one good thing about the high interest rates that we have now, it's that this market here is finally starting to get a little bit of time to heal and that inventory start to build. Yeah. Okay, to kind of summarize the thesis here, the point I'm trying to make in this video, conditions are terrible in existing home sales. Eventually those conditions won't be terrible anymore, and a lot of businesses that are currently negatively and adversely being impacted by those said conditions will not be forever. And so on my screen I have a picture of one of my favorite companies that have been adversely impacted by these conditions, and that's Redfin. And Redfin, I will say, I'm going to make a video on it more specifically. It is more speculative. This company has never shown a profit, but a lot of traditional brokerages are out there. They've been negatively impacted. They're prop tech companies. If you look at these charts, they all kind of look something like this, right? And so in 2020, 2021, a lot of these stocks skyrocketed. Again, if we compare that to existing home sales, the market's never forward-looking. It projects current market conditions into infinity. And as a result, this stock was trading at about $100, right? Now, again, we're at some of the worst conditions ever in the existing home sales market. And currently, Redfin is selling around an all-time low at around $6. And I don't think that this stock is going to stay down here. I don't think most of these stocks in these spaces are going to stay down here, right? And again, I'm going to make a video more specifically on this, right? But again, just like the market wasn't forward-looking at the top, they tend not to be forward-looking at the bottom, right? So now that it's down 95% from a peak, there's not a peep out there. Nobody's interested in it. One of the things I find funny, and this is anecdotal, it's not really evidence-based, right? You know, all of the guys who are involved in, or the CEOs involved in these kind of, I don't know, prop tech kind of companies, they get asked to a bunch of interviews on YouTube and, you know, traditional news outlets, and I never really hear them talk about their business anymore, but they're always concerned with their insights in the market. So there's this weird kind of doomerism taking place in, you know, real estate in terms of affordability and all that, and there's just an all-time low in interest in what is clearly cyclical businesses. Yeah. So I'll make some videos on some companies that I find interesting. I'll probably make one on Redfin and even why I like it, even though I think even though it has never been profitable, but I think that could change in the future. But let me know what you guys think in the video below. If you have questions on what I'm talking about, this idea, you can put those in the comments as well. Take it easy. I'll see you guys soon.